Here's what you need to know about the Bank of Canada policy interest rate increase as of September 7th and why you do not need to panic in locking into a fixed rate at this time. As you can see, September 7th, we had another significant increase of 0.75%. What this means is anybody in a variable rate mortgage will now have their mortgage rate increase another 0.75, which with all the other significant increases we've had in the last few months are causing people to logically second guess their variable rate product that they're in and go to a fixed rate. But the question is, should you get into a fixed rate at time and present, or should you wait? And the simple answer to that is to realize that variable rates do not necessarily have any full correlation or connection to the fixed rate products. They can have some sort of an impact. However, the fixed rate market is more based on the bond yield, the Bank of Canada 5-year bond yield. And everybody can look at this on the Bank of Canada website. And you'll see here the last 20-year history of what the bond yield is doing. And notice just in the last year here, how significant it has come up to the point of almost 3.5% as the bond yield has increased. What is also significant is when we've had these large rate increases on variable rates, notice here, on July 13th, we had a full 1% rate increase. If you look at the correlation to that, in July, after that rate increase, the bond yield actually dropped nearly 0.75%, meaning fixed rates actually came back down. And that's what we started to see. So the begging question remains right now is, are we going to see a decrease or an increase in the bond yield? And is there any correlation with this policy rate change? And what many economists are stating and clarifying for everyone right now is because of how significant these rate adjustments are from the Bank of Canada, if they do their job in decreasing inflation, we could potentially get to the point of even a recession. And even if it's not a full recession, the bond yield could start to come back down. The simple answer for you today is if you're currently in a variable rate, you need to ask yourself this question. If the trend that we're seeing is every time the Bank of Canada is increasing rates and the bond yield goes down, can you hang tight in the variable rate you have right now, stay flexible, and wait for the market to cool even more? Because that is what we are expecting. The Bank of Canada is triggering a reduction in people spending money. That's what they do. With these rate increase policy changes, it decreases spending. History has shown time and time again, in any recession, fixed rate yields come down. So hang tight if you're in a variable rate, or if you feel you need to make a change, really consider the history and trend on that based on affordability and go from there.